Well, welcome to our launch event, actually first launch event of our Chatham House International Risk Briefing, CHIRB. And welcome to all of you here. We're going to film this event, this presentation, and the Q&A session. And we have a couple of people who are actually connected remotely. This presentation will be on our special area of our Chatham House website. And again, you can have access to it with your password. And so this presentation will stay online and for future memory and for anything, for referring to any of these points we will be discussed. So the purpose of today's presentation is to literally discuss and present and go through each of the points we present in today's CHIRB. And so again, the document is on our website, so you have received, I believe, the link to this document. What I'm going to do is to go through it slide by slide and sort of guide through our thinking, so to make it more, if you like, user-friendly, because we are aware that it is a document and it has a very special format because it's a PowerPoint presentation as opposed to a paper. But we're also aware that there might be questions. So I will use about 20 minutes to go through this briefing, and then there will be a Q&A session. Of course, you're always free to call us, and if there is anything you want to discuss. You can see the title. Obviously, we focus on the ECB's QE. It is very, very timing, but I think what we try to do here is to go beyond the technicalities of QE, of a move in monetary policy, and trying to understand the implications, which are not only economic, financial, and monetary, but they are much broader, and implications not only for Europe and the immediate region, but also for the rest of the world. And our assumption in this brief is that there are risks which are also geopolitical, not only economic and financial. So this is a big event which will have quite a lot of spillover impact. And that's why we said it's a global game changer. So it's not only something which is important and relevant for Europe, but has potential to change the game everywhere else. And so there are the risks, and that we try to focus on those risks. We start in our first slide. As always, we follow a format here in order to make, again, this brief more user-friendly. And we chose two quite opposite quotes, one from Mario Draghi, which actually suggests very clearly then quantitative easing for the ECB is not only because of deflationary pressures in the Eurozone, but as a way to support economic growth. And in a way, as we say in our brief, Mario Draghi is stepping into a more political area, a more political dimension. So in some way, it's moving the boundaries of what is the monetary policy a la ECB. And the other quote is from Angela Merkel. It's a bit strange. In fact, actually, I don't know if it's very completely crystal clear. We checked it several times, but apparently she said exactly this. Maybe the translation is not particularly good, but basically she says we have to be sure that then QE doesn't remove the need for structural reform or the urgency for structural reforms in countries in Europe, in particular in the periphery. And we have then slides with the acronyms to make the whole briefing easier to follow because, again, space is limited, so we use a lot of these acronyms. But I don't think that requires a lot of explanation. The risk overview, again, we started what happened. We chose two events. One is the announcement of QE by the ECB. And again, in itself is not a particularly dramatic event because it was quite well expected. And in fact, we say that Mario Draghi has actually forward-guided the markets quite effectively. But there was the other event, which to us is very relevant to show the kind of implications and spillovers impact that the QE of a big central bank like the ECB has on other countries. And so it was the announcement before the move of the Swiss National Bank, the Swiss National Bank coming out of the peg against the euro. And again, really, this is to us somehow epitomize the fact that this central bank, as the Fed before, and now the ECB, and to some extent also the Bank of Japan, what they do is not in a vacuum, is not only regional, has not only a regional domestic impact, but has much more larger impact, even preempting the impact of the move of the ECB. And why did it happen? We know is the deflationary pressures in the euro area, and the cost for the Swiss National Bank to defend this peg if they continue to keep it once QE were in place. Why does it matter? It matters because, again, the QE, as I said, Mario Draghi prepared the market, forward-guided the market, and it basically is the obvious consequence of what we call the doctrines or whatever it takes. And it also indicates Mario Draghi was very clear last summer at the central bank gathering in Jackson Hole in the United States. And he was very clear that growth was a critical element of his thinking. And so you can see this, so as I say, this is a political or a policy move, but with also important political implications. So it's because growth is important in Europe, but also is a move which is somehow preempted the outcome of the Greek election. So in other words, you can even see it as a way to prevent another crisis in the Eurozone. Again, that will maintain a relative safe environment. But the interesting thing is this move basically shifts risk globally. So if the euro area remains somehow risk-free, the risk is sort of moved somewhere else and becomes a bit more difficult, and it can cause a potential market volatility and a repricing of assets. And the other important consequence of this move is that there is the boundaries between monetary and fiscal policy becomes a bit more porous. And I just come back from Japan, where I was involved in really interesting and long discussions about QE in Japan. And obviously, they were very interesting to know what Europe is doing and how Europe will do it and which will be the consequences. And it's very interesting. In Japan, this link between monetary and fiscal policies is much more there's much more a revolving door, and it's a different way to work on policies. So the policy shift, we know what they are. So the QE willingness, the ECB has signaled his willingness to expand his balance sheet. So again, unlike the Swiss National Bank, it just say we actually create money and create more liquidity. And there is a sort of replacement in the global game. So now that the Fed has stepped down, then we have the ECB, then with the Bank of Japan will provide liquidity to the rest of the world. So they are the global source of liquidity. At the same time, a national domestic central bank like the Swiss Central Bank really found the impossible to deal with this situation, which somehow stepped down, even if Switzerland issues what we can see as the key safe haven, the Swiss franc. And there are some anticipated risks. And for us, the anticipated risks are not so much in terms of creating inflation as a result of large creation liquidity. That is not a risk for us. The risks actually are more in terms of the impact on the real economy. And the point is that there's been so much expectation. So now I think, I don't think any move of a central bank has become so sort of popularized like this one. And so there's so much expectation, and certainly, and suddenly, the situation, the real growth will pick up in, the real economy will pick up in Europe, then there is a strong risk of disappointment, which could impact on the already quite strong anti-Euro sentiment in some part of the periphery. And there is a global impact. The global impact is now we have the US actually has regained effectively is the role of the engine of global growth. So Europe is not there, and it will be difficult to be there. And it will, obviously, there will be more capital flows getting into the United States, and the dollar will become stronger. So this can open scenarios of, again, going back to the narrative of currency wars, which is something we don't recognize, but is something which has a very strong political implications. And the emerging market economies will find more difficult to attract foreign investors because, obviously, the strength of the dollars, and because some of them are not strong enough, I mean, the fundamentals are not strong enough to be really competing with the United States. Again, these slides tells us what happened in more detail, so I won't spend much time here because I believe it's pretty clear. And we look at why it happened again. We broke down the reasons in terms of market factors and policy factors, and we tried to understand how these two different kinds of factors play with each other. And again, it's another, I think this chart is possibly quite clear. The interesting thing is then there's been a lot of discussion about the QE and a lot of coverage in the media. The interesting thing is then it seems like a massive intervention by the ECB. Actually, in terms, in relation to the other central banks, it is not. And the interesting point of this chart that a lot of people find people who are not familiar with the ECB find it very interesting, and particularly, I say, in Japan, people find it very interesting to realize that actually the ECB, at a certain point, after having increased its balance sheet, it started to reduce it again. While if you look at the Fed and the Bank of Japan, the support through QE has been much, much larger. So in some way, the political situation in the Eurozone affects the move of the central bank. It's a sort of somehow timid and is not like a fully fledged whatever it takes. So Mario Draghi predicates in terms of whatever it takes, but actually political constraints limit this statement. And one thing that the Japanese, the BOJ, one point I picked up in conversations with the BOJ this week was, it would say you need to do it as much as you need, and you need to create so much liquidity until it's needed. So that chart tells you the political constraint of the ECB. Again, in part of the analysis, we look at the forward guidance, how a central bank like the ECB has guided the market, a bit like the Fed. When the Fed guided the market and indicating the tapering of QE, there was a massive volatility on the emerging market that was in May 2013. And for the case of the ECB, it wasn't even the announcement created this reaction in Switzerland, but not only in Switzerland, because there are other countries around Europe which are pegged to the euros and will find more and more difficult to deal with the spillovers from the monetary policy. Now we go into the more political issues. And again, this chart shows a sort of polarized debate. It's a bit, maybe we characterize into strong terms here, but it's a sort of indication of how some economists see central banking. So in other words, we say there is not much, you can create liquidity, and it's more like, again, whatever you need. And there is no reason, in theory, not to continue to expand liquidity. But that is something that some, not say all, but lots of voters or politicians actually resent and are against. So, and they see then their concern about risk from excessive monetary easing, risk of inflation, undermining monetary credibility, problem of independence of central banks, problem that central banks might need to be recapitalized, and therefore problems with independence. And again, the thing that managing currency is a risk strategy. So that's, again, it seems to me that going forward, we will see more and more of these views. And this is we move to try to illustrate these sort of political dimensions of the ECB moves. We try to illustrate with gold prices. I know that this is a sort of controversial, because when we talk about gold, it's always a bit problematic. But gold for us, we use it here as a proxy for political risks somehow. And the political risks, like there are a number of voters who do not see this managing of the economy and monetary policy as a healthy way to move the economy forward. And therefore, gold, it really, if you see the gold prices tend to go in a sort of inverse correlation with the various announcements around monetary policy. So more money created and more liquidity in the global economy, more people think that gold is sort of safe haven. And we made here a point, which I know is controversial, but they say, what happened? We try to think, what happened if the Swiss franc become less of a safe haven? Again, which actually are, what is left in terms of safe haven? And I know then the Swiss franc actually strengthened after the announcement, but there is also a possibility that the Swiss National Bank lost a good deal of credibility. Some people might think then they cannot trust central banks. And we know there are people who do not trust central banks. Therefore, they move to gold. And plus, there is no opportunity cost to holding gold if interest rates are below zero. And again, this is another thing we are going to see. It's what we call monetary dysfunction. Now, a lot of central banks are in various countries trying to respond to the move, and some of them really go below zero. Now we look at the regional, global, so the country regional global effects, and obviously we use country here in terms of the Eurozone. This is something, again, we try to think of this move as with an impact which goes beyond the Eurozone. So in terms of the Eurozone, what do we see? We see the impact on QE is mainly on the exchange rate. It's something that it cannot be said in polite company, but that is the reality. And is actually helped to stabilize market conditions, and particularly now, then the political situation in the periphery might become a bit problematic. We see some impact in anchoring inflation expectations rather than moving the inflation expectation towards the 2% target. And in particular, this is helpful for the periphery where the demand has been quite severely curtailed. But we see little impact on growth, and that is the political, if you like, issue and risk. At the regional level, and we talk about regions, we think about Europe as a whole. So the spillover from the EU, the ECB is, we saw already Switzerland, and the UK, we probably see an increase in capital inflows, then a strengthening of their currencies. And then again, obviously, you have to take into account all the other factors as well. This is really, and we see here a risk of spillovers on the EU debate. So again, if you go into the mode of currency war, or say thinking of, again, the problems creating by once again, the Eurozone, that could really affect negatively a very already quite harsh debate on Europe in this country. And for the Bank of England, again, we see the Bank of England stay on hold for quite a long time. And there will be problems for other, what we call outs. So other European countries which are not members of the European Monetary Union, like, for example, Sweden and Denmark, that will find difficult to maintain their peg against the euro. So a situation then creates a way to managing the economic policies in other countries. And then there will be a global impact. Again, the dollar will be stronger. As we know that some part of the Congress in the United States are very sensitive about this, again, currency issues. So we might expect a return of this currency issue narrative. And the scenario becomes even more complex for emerging market economies and developing countries, in particular those with their currencies linked to the dollar, because they will experience, obviously, a strength in the currency and more difficult to manage. We see already the moves from India and Turkey. And we'll probably see more of this of emerging market economies, which will find difficult to. They will see a trade-off between maintaining financial stability and improving their growth, and they might decide to cut interest rates even if the conditions are not quite right. We did our risk assessment. We built 3 scenarios. So the one in red is high-risk scenarios, medium-risk scenarios, and low. Go quickly through these scenarios. The euro area, we see the worsening. The high risk is worsening of imbalances, falling price and debt deflation. That means the QE in the end doesn't work. So effectively, high unemployment and political uncertainty and more an exacerbation of the anti-euro sentiment. For Europe as a whole, we see monetary disruption, slowdown in growth, a result of again, effect on the exchange rate, and worsening of anti-euro sentiment. And global, again, monetary disruption. More countries need to go into negative interest rate as a reaction, or reduce interest rate as a reaction to these spillovers, and the return of the narrative of currency war. The medium scenario is the one we think is the most probable. And again, we see inflation expectation anchored, but no significant improvement in growth on the labor market. That will really means that there will be no improvement in the euro, in the sentiment towards the euro. So we still see this fundamentally anti-euro, some part of the population fundamentally anti-euro. Some monetary disruption in the rest of Europe with worsening of our trade with the euro area. And then for the global monetary disruption, worsening of our trade, and the US is the global engine of growth. This is not a surprise, but we've been used in the last 10 years, and particularly after the crisis, to see other countries, although countries which were growing very fast and also becoming larger economies, and particularly I have in mind China. China is correcting its growth trend. And so the US is now effectively the only global engine of growth. I mean, a country which is large enough to pull the rest of the world. And Europe is not there to be seen. Low probability, scenarios with low severity is stronger GDP growth. Inflation expectation moved up to in line with the 2% target, and better political outlook helps reform in periphery. This also is the low severity and also the best case scenarios, which is not growing to happen, and basically very little impact on the rest of the world. So this is another way we sort of look at the likelihood of this risk, and we divide it between political, economic, and financial. very likely increasing the anti-euro sentiment. That's what we see going forward, and this is something that needs to be watched. In economic terms, we do not see any risk in terms of inflation in the Eurozone, but we see a risk for slower growth for the rest of the world. Financially, unlikely financial instability in the Eurozone because somehow the whole situation has been locked into this very high liquidity environment. But we see financial stability elsewhere as a result of the spillover from the Eurozone. So our scorecard, and short term, again, we divide, the colors indicate the, the color indicates the impact, so there is a mistake in the legenda, and the numbers indicate the probability. So again, if you see the Eurozone, high impact, low impact, and domestic impact, but, and high, economic, I'm talking about political risk, high impact and high probability. Regional impact, again, political risk is high, and global impact is medium, and again, the probabilities are correlated. The economic risk is much stronger in some way, the impact and the probability at the regional level, much less at the domestic level. Some of the impact has been factored in, and less at the domestic, at the global level. And again, the financial risk is the impact will be very high for the Eurozone if things go wrong, but the probability is very low. So that is where we see less of a correlation. Medium term, again, political imbalances, more questions about the independence of the ECB, and about the democratic deficit of central banks or the technocrats. And this is something which is now came out very clearly in the in the debate in Greece as a result of the election. And then fiscal, there will be more debate about more fiscal flexibility and policy to support demand. And so, again, this is something which has surfaced in Greece, but is not only a Greek issue. And for the economy in the medium term, so let's say the next 2 years, the outlook for the labor market remains critical, but there is no significant change. So again, we see high unemployment, maybe with just some marginal improvement. And going forward, we see a weaker economic outlook for the United States. So the United States is the engine of growth, but the United States has intrinsic weaknesses. And so that will be very important, something to bear in mind for a longer term. Financially, this is where the risks are higher, in particular if there will be central bank will be, and some of the central bank will be under more pressure to disengage from accommodative policies, so in particular the Fed. So the Fed moves into increasing interest rate. That could create quite a lot of problem. And, but also, it might be, there is in some way, bullet 1 and bullet 3 contradict themselves because it's either or, we can't have two scenarios. But it's also possible that central bank stays on hold for a long time, and so we really get this secular low interest rates, which provides all sorts of problems, creates all sorts of problems in terms, again, how to sustain pensions, how to really get the economy going and investment going. What next? Again, we think that the Fed is going to stay on hold, probably, again, now is factoring a move early next year, and maybe even more than that. Mario Draghi will push Euro member states to do more to support growth. So again, the debate about growth versus fiscal consolidation. And there will be some outflow in the euro area, but not much of adjustment. So the fragmentation, the financial fragmentation we have been seeing since 2011 will remain, actually become perhaps even more evident, and anti-euro sentiment remains unchanged. And for us, in terms of political risk, this is the real thing, the thing we need to watch. That's it from me, and thank you for your attention. I look forward to questions. So I think we need to use the microphone in order to allow people who are not here, they follow on remotely to hear, and also it's good for our film.
Okay. Emma Martin from Bosch, thank you very much for the presentation. I have a question. So in following up all the analysis, it seems to be that there will be shift in power between Europe and US and Asia. But going forward, the bottom line is, as you said, also that Europe as it is, there are lots of fragmentations in the political arena, Greece as well as here in the UK. What's the implication for the UK political perspective going forward for the election on the power of shift in Europe?
Okay. Well, this is a very important question. I'll try to answer within the framework of this presentation. And again, for us, the way we see it is this economic, monetary, and financial situation outlook for the Eurozone will have an impact on the debate in the UK. Partly because everything will have an impact at the moment on the debate in the UK, but partly because there will be a clear, of course, there are other factors at play. So it's not like because the euro get weaker, then there will be an immediate impact from through the exchange rate channel on the sterling. But there will be some impact, and that will be enough to really, if you say, put more, petrol in the fire. So just getting people even more sort of charged up against Europe. So in other words, this could be seen as a beggar your neighbor kind of policy. And what I said before, obviously nobody can say, and nobody, the ECB obviously will say this is, this move will affect. The only way growth can pick up is basically through the exchange rate, because there's no way then this move will have a strong impact on the banking sector in Europe, in the euro area. So this is not something that you can say, lightly, because there are huge political implications. But the fact that there will be a weakness, the exchange rate will be weaker, that will be really perceived as a beggar your neighbor. That was again the case with when we had the currency war at the time of QE from the United States. QE2 was again Brazil went public, said, well, we have currency. They sort of created this war. That was the reaction regionally to the QE in Japan. So there was a lot of hostility because of the exchange rate impact. I don't see the situation different here. And we have seen already some of the issues. I mean, Switzerland, again, got other countries in Europe. And I think the UK will be one of them. I mean, again, this is what we think. This is a way for us, is a way to spell out risks. Then obviously, everyone has his own assessment of risk, but that's something for us to watch.
Zidon, Kate Gibbons from Clifford Chance. Paolo, you mentioned obviously the US and Europe, and you've discussed what the results of your discussions were in Japan, but you don't mention China. I wondered if you had any observations on the impact of these steps for the Chinese economy.
Well, the reason we didn't put China into this mix is because of a very difficult way to a different way to manage a monetary policy, and so the Chinese they manage the exchange rate, and so they're not. The PBOC is not a central bank like the Fed and the Bank of England, but BOJ and the ECB. Again, BOJ, we can even discuss whether the BOJ is actually truly independent. As I said, there are very, very wobbling boundaries between fiscal and monetary. But definitely the PBOC is in a different category. And plus, the other issue is the renminbi is not a key reserve currency, is not a reserve currency. So when we talk about the moves of central banks which have an impact on the rest of the world, we talk about central banks of countries or areas that issue key reserve currencies, so the dollar, the euro, say the sterling, because there is a reserve currency, and the Japanese yen. But we will actually look at China in another brief.
Jeff, UBS. We've already seen the political backlash in Greece already. I was interested in your view on Podemos in Spain and Five-Star Movement in Italy, whether this will give a fillip to these two organizations. There's an article in The Economist for this week suggesting Podemos' support probably will not rival that of Syriza. So how do you see these two developments, so these two parties playing out, and how does that impact your risk assessment? Thanks.
Well, this is when I say the anti-euro sentiment, I really have in mind, well, there are two aspects of this euro sentiment. And again, we use a big box, anti-euro sentiment, but actually inside that box are different groups and different connotations. So again, I would really separate from the anti-euro sentiment in Germany and the anti-euro sentiment in the periphery. In the periphery, the narrative, and again, is now a bit more tame than it used to be just a few years ago, because Podemos and Syriza, they do not want to leave the euro area. They want to stay within the euro. In Italy, it's more mixed, but the Northern League and the Five-Star Movement are campaigning for leaving the euro. So. And the reason is because of the euro is, the currency is identified as the big constraints to growth for this country. So they said in a very blunt way, a flexible currency, going back to their own currency, and that means they can depreciate the currency and then gain on competitiveness, but I think is a very simplistic and a wrong approach. So at the moment, as I said, it's a very fine line, and Mario Draghi understood very well that growth is essential in order to keep the euro project together. Because if we go forward, and again, what I think is very, very concerning is our medium-term assessment, potential risk, is the fact that, again, we do not see a big change in the outlook. So a change which could shift the sentiment. That means, people get jobs, people get, they see the economy moving. And the best case scenarios is we have, 1.5, 2% growth, and then for some countries, just achieving that kind of growth is already something. That is not even a growth which help recovering the losses from the crisis. So that will impact hugely on the anti-euro. And again, there is this, the other part of this narrative is the central bankers as the technocrats, not elected democratically. And, you can see Alexis Tsipras' line is, he doesn't want to talk to the Troika. And he doesn't want to talk to the Troika because the Troika are the technocrats. He wants to talk to democratic elected government. And so again, that's really important in the perception of the central bank. This is why the whole shift now in QE, and QE becomes more permanent. If you remember, in 2009, when the Fed launched the first round of QE, was actually something like perceived as a temporary, as it was in the UK. Now, we're going to live with this for a long time. I saw some projections by the BOJ, and the QE is going to stay for quite a long time. And not only QE, but then there will be the exiting, and it will take a long time to normalize monetary policy. We're talking about scenarios of 10, 12 years, so it's a long time. And with the huge implication for, again, welfare And we haven't even discussed the impact, as I said before, on pensions and annuities and kind of thing. So it is a big issue. So this really somehow this move shift the attention even more to the fact that there are huge impact on people's welfare, defined in a big way, coming from people who are not democratically elected. So, and that really is, to me, a serious risk, and that will really trigger a big debate. I mean, with Tsipras and Syriza, we've seen the tip of the iceberg. I expect to see more in other countries.
Shall I go ahead? Hugo Doyle from Intesa Sanpaolo. Just linking up with your point on exiting QE that you just made, do you see any risks relating to central bank independence and independence of the ECB coming from its action on QE and the potential likely capital losses that will accrue to the balance sheet of the ECB deriving from this action, given that yields now are at extremely low levels, and to buy rich bonds now on that level seems a good recipe for losses?
I think going forward, but as I said, as I said in one of the first slides, Mario Draghi has basically, this move really pushed the ECB in a different territory. So it is more, sort of the boundaries between monetary policy and fiscal policy are now more porous, even in Europe. And going forward, I think we've seen this, the crisis has actually adjusted and helped adjusted some of the we say design problems with the euro, institution design problems with the euro, the monetary union. And I think one of the things is, again, some of the sort of pillars of these constructions have proved not to be sustainable. And so I think going forward there will be a good rethinking de facto of the role of the ECB. And I see the ECB, this is my opinion, going more towards the model of Japan. And I think it's very interesting, the Abenomics and the three pillars, so monetary, fiscal, and structural reform. I mean, the lessons or the ideas for Europe are there. So I don't really see going forward. And the monetary policy, well, the ECB has already stepped into a fiscal area. So going forward, I see even more. But the question is, and this is why the risk, and going back to the political risk, this stuff has to be done in a transparent way. And so I think at a certain point there will be a need for a debate on, how we manage this. You can't really carry on doing things without hoping to just make an adjustment without explicitly call things with their real name. And the other chart we have here with the intervention, the size of the intervention of the central banks. Again, this is to me is the political constraint. These charts done one is the total asset, the other one is as a percentage of GDP. This chart shows the political constraint of the ECB. And this is something that will need to be somehow resolved. And it's not an easy resolution. And again, the political constraints are in the fact that the ECB takes up 20% of these assets. The rest go into the domestic national central banks. So again, the risk is pushed towards national central banks, and so the potential risk of recapitalization is with the national central banks more than with the ECB. And that creates more fragmentation in Europe. And again, there are all sorts of scenarios open there, and nobody knows exactly which would be the one which will prevail at the end. But one is possibility you keep this debt in the balance sheet of the central banks forever. Because for some countries, it will be really difficult to come out of that level of debt, in particular with no growth. In the mic.
John Nugent from Chatham House. Paolo, thank you for this, and this is the first of your briefing. And I wonder if, as you develop this briefing series, and in particular, as you develop thinking about central banks, you might add another risk into your pack of things you look at, which is the risk of administrative error. We are now so dependent on the authorities that the central banks are no longer at the background of markets, but they're very much at the foreground. They are, in some cases, the markets. Being a former central banker, I never criticized central banks, but I would have said the Swiss National Bank was not very proud of what happened. And I just leave you with the thought that administrative error and volatility coming from administrative surprise is another of the risks that accompanies much more active central banks.
Absolutely, and that's why somehow we were hinted to some of these issues when we said we talk about the response of other central banks to the spillovers from the big guys. And that sometimes that response, it could be completely wrong because you need to act. You know, we are puzzled about the response of the Swiss National Bank because there were other ways to deal with the problem of managing the spillovers from the Eurozone. Why that happened, I don't know. We tend to think then central bankers become sort of superhuman, like, you know, they're able to deal with everything. You know, you're right, they make mistakes, and maybe you need to act fast, and you don't think very sort of, you don't look at the big picture, you just react in a sort of tactical way, and then you make mistakes, and there is room for that, exactly. And so more and more we're in a situation where there is scope for mistakes, and the mistakes are now, sort of the bar has been raised so high that, you know, it just, we're in a different world. I think we just shift the completely, we're changing this global order back again to the role of China, India thing. I think we are in a different situation, in a different world from where we were 10 years ago. And maybe again, we need to rethink of a lot of assumptions we made 10 years ago around the new global order. And maybe we're back in a situation where, you know, basically we got a big play and some other big plays, and then determine the rest, how the rest of the world interact with them. It's a bit of a game theory kind of situation. Right, so if there are no other questions, well, thank you very much, and thank you for being with us today. I hope, as I said, this is our first live event, and so we'll learning by doing, and so bear with us, but it will be very useful for us to get your feedback. And of course, if you have questions, and you received this brief this morning, so if you go back, you have questions, just give us a call or send us an email, and then we will explain some, you know, if you have queries in particular about the brief. But thank you very much, and I look forward to see you next month. And goodbye to all of who are abroad or connected remotely. I hope they had the chance to follow the presentation. Thank you.